Okay, let's begin. If people could just take their seats, we will start. My name is Andrew Dawson. I'm from the UK, from the Revenue Department in the UK, and I'm the chairman of Working Party 1, the group here that's been at the OECD charged with the responsibility for taking forward Action 7 on permanent establishment. Welcome to you all. Thank you very much for coming. We certainly appreciate the efforts that everyone has made to get to grips with the options that we've put out in our paper and to provide your written comments and to come here today. We've received around 100 comments. Comments from around 100 organisations. They're all on the website, the OECD website. So if you don't see your comments on the website, it means that we haven't received them. We received a huge number of comments, around 850 pages, and it was really very gratifying to see the way that people have engaged with us on this issue. Just let me say a few words of a general introduction. You'll see that, well, you've all correctly identified the flags behind which you're sitting. What we've done is had one seat at the table per organisation that has submitted comments and indicated, obviously, that they want to speak here. Those of you who are on the back row, that's not to say that we don't value your comments, so we very much hope that you will be able to speak today if you wish to do so. The procedures for speaking, as I'm sure most of you know, if you want to speak, just raise your flag like this. And for those of you on the back row, if you kind of indicate that you want to speak, and I will acknowledge you. And then the best thing is if you can make your way over to one of the microphones in the corner. And the reason for that is that this meeting today is being webcast, and welcome to anybody who's watching. The meeting is being webcast, therefore you should assume it's being recorded also. But that means that, well, the way it works is that when you speak, when you activate the microphone in front of you, the camera will focus on you, so you'll be on TV, and the camera will also focus on the microphones in the corner. We don't have the technology to make the camera focus on a roving microphone, so although we do have roving microphones, it would be best if you could make your way to the ones in the corner. The purpose of the meeting today is for us to hear your comments. In a moment, Lisa Lotkana is going to make a few general remarks, but our object is not to present what we've done, except in a very high-level way. You've all read it, you've all commented on it, so we don't feel we need to do this. Nor is our purpose here to sort of engage in a debate and defend what we've done. I don't think that would be a good use of our time today. We've received so many comments, and what we want to do is to hear you present your comments, and so allow us to get a feel for for what's really important. And delegates, government delegates around this end of the table will, I'm sure, take the opportunity of maybe probing a few of the questions that they have about the comments that you've made. Which leads me on to saying what our next steps will be. The comments you've made are on the basis of our 31st of October consultation draft, which contained a series of options. They weren't at that stage our proposals. They had as we would say in the UK, a sort of a green tinge to them. And what we will do as a result of this of the comments you've made, as a result of today's meeting, is we will meet again in March to consider further what will become our proposals in the light of the comments that we've received, with a view to putting out probably a further discussion draft sometime in the spring, which would be a much more of a kind of a white paper approach, which would at that stage contain firmer proposals rather than at this stage a wider range of options. So I hope that's I hope that's a clear indication of the way that we're going to go. I don't think there's anything more I need to say except to introduce Lisa-Lotte Kana. Lisa-Lotte chaired the subgroup of Working Party 1 that was responsible for this work on permanent establishments. So without further ado, let me hand over to Lisa-Lotte.
Thank you, Andrew. Yes. As Andrew has pointed out, this is actually for you to explain and comment on your comments, and not for us to speak very much. So I won't take up very much of your time. I just thought I'll make a few comments that could be helpful as an introduction. First of all, this is not a final consensus document from the OECD. This is a discussion draft with different options, and the particularity with the BEPS project, as you all know, is that it's a G20 OECD project. And therefore, as you can imagine, the views are of a wider spectrum than perhaps with just OECD members. So it's of course has different options, and different countries and different members have different preferences. But I think that's something that we should keep in mind, that it's not going to be an easy task to get some consensus on it. Also, I would like to mention that doing nothing is not an option. We have instructions to do something. So although some of you have made the comment that it's better not to do anything, that is not an option that we're going to go, that's not the way we're going to go forward. Also, some comments were made that we went further than the examples that were made on the commissioner arrangements and specific activities. And just for your clarification there, the mandate is actually just given as examples. It was never restricted to those examples. On the positive side, the list of examples is very useful for us, that you have given of different ways that these could work, and we would definitely work very hard and looking into those examples. That is very useful for us. Practical examples, we're going to work very hard on that. Also, alternative proposal is very, very useful. Perhaps sometimes, again, doing nothing is not an option, but it is useful to have different ideas, and so we will look at that as well. And finally, perhaps a word about the attribution issues. There were some comments. Paragraph 45 of the discussion draft actually only mentions that perhaps there need to be clarifications, but we wanted to make sure that from this subcommittee or this focus group, it is clear that we don't need to change Article 7, and that is the only comment that we have made. There might need to be more guidance, but that is not part of our work at present. So just again, as Andrew said, this is actually a meeting for us to listen to you, so I'll give back the word to Andrew. Thank you.
Thanks very much, Lisa-Lotte. You've all got the agenda in front of you. I hope it was put on the table and on the chairs. So we're just going to follow through on the agenda, and you'll see that the next item is some general comments from BEAC, and Will Morris, the chair of BEAC. Welcome to you, Will, and I'll turn the floor straight over to you.
Thank you very much. This could be the last time in the day when we're ahead of the schedule as well, but I'll try and keep to my part of it. But I wanted to thank you, Andrew, and Lisa-Lotte, and Marlies, and Jacques, and indeed all the government delegates for the opportunity to speak here this morning at this consultation on PEs, and to offer just a few opening remarks on behalf of BEAC and the OECD business community. First, and I should say for those of you who are going to be around for the next few days, I am actually going to use identical language right at the beginning of these general statements. I do want to acknowledge the significant effort and thought that's gone into the discussion draft. Operating under impossible, some might even say ridiculous deadlines, which were not of your own making, you have nevertheless produced a document which I think shows a lot of hard work and which poses a lot of important questions which we have tried to answer. I also want to acknowledge, and I think this is very important, that we do also understand, as you've already said, that this is an early draft. It's not a consensus document or a polished conclusion. But in fact, you responded to our request for an early opportunity for us, business, but also for other stakeholders to engage in dialogue with you. And finally, I think it's also very important to acknowledge how open the process of consultation with all stakeholders has been and the genuine effort which has gone into that. So let me just say a general word or two and then raise a couple of specific issues which we do go into in more length in the comment letter. The current PE rules have worked well over the past 50 years in that they provide certainty and stability which has encouraged business to engage in long-term cross-border trade and investment. Many of the major principles, such as the authority to conclude contracts, are well understood legal concepts with broadly agreed meanings. We do, nevertheless, understand that in recent years some governments have seen planning techniques which they believe seek to exploit the elements of current rules, for example, those on the conclusion of contracts, or the preparatory and auxiliary rules. So we understand, to Lieselott's point, that the PE rules are likely to change, but we would make three observations. The first is any rule which makes it easier to establish the presence of a PE will almost certainly increase the substantive and administrative costs of doing cross-border business for companies. Second, if those rules are changed, then it's crucial that any new rules be clear and at least as well understood as the rules that they replace. If there is any vagueness or ambiguity in the new rules, then that will inevitably increase disputes between countries with the resultant increase in double taxation. And this second problem will be exacerbated if it proves difficult to make substantial progress on dispute resolution under Article 14. And finally, in its current form, this project does, I think at some level, implicate the balance between source and residence country taxing rights that is explicitly not part of the BEPS project. We do feel, however, that it might be better to have that conversation directly rather than perhaps through the proxy of the PE rules. So on specific issues, just a couple of quick comments. We do understand that commissionaire arrangements are seen by many governments as being aggressive or even abusive, and we do recognize that changes will be made to address those concerns. However, we do worry that some of the proposals will go beyond tackling those arrangements and could impact other unintended structures, thus creating more friction in the system for cross-border business. For example, options A and C appear to implicate any relationship between an intermediary and a customer, and that would obviously have a very broad impact. Also, the proposals under option D, taken all together, would substantially increase the subjectivity of the threshold. So, although we can't fully yet endorse any of the options as they stand in the draft, it does seem that option B could be the least damaging and has the greatest potential to provide some certainty and objective clarity. So we would be very happy to work with you to try to help develop a clear definition of what is meant by the material elements of a contract, which we believe will actually be as beneficial for governments as it will be for taxpayers. On the activity exemptions, again, we completely understand the intentions behind a preparatory or auxiliary override. But again, we do worry that the removal of clear and objective exemptions will take away much of the certainty from the PE standard. A case clearly has been made, for example, for the removal of the delivery exemption, but nevertheless, broad international agreement would be needed on how that removal would impact a range of very routine situations. Our final specific point relates to the lack of focus on attribution of profits, again mentioned by Lieselott, which is often the most significant challenge in dealing with PEs. An increase in the number of PEs will inevitably lead to an increase in this challenge, especially where losses are concerned. And again, further practical guidance could reduce the difficulties that will be faced by taxpayers and tax authorities in this area. So again, thank you for the opportunity to comment this morning. We do look forward to working with you on this project and hopefully bring it to a successful conclusion. And I do want to emphasize again how anxious we are for this to succeed. If occasionally we sound a little grumpy, do put that down to the same timetables and the same pressures that you yourselves are facing. We're all in the same boat on this one. But we really do genuinely appreciate the opportunity to participate in the process. But, and I really will stop after this, we'd implore you to be very attentive to the dangers of changing the PE rules without widespread agreement amongst the G20 and OECD countries, and of doing so in a way that broadens rather than narrows any ambiguity surrounding the presence of a PE, because that will be to the disadvantage not just of taxpayers, but also of tax authorities. Thank you very much.
Thank you, Will. Thank you very much. we've had some indications of people who say that they would like to speak, and you'll see that that's on the agenda now. So we're going to begin this process, this next item on the agenda, with Carol Donoghue from the Treaty Policy Working Group. Carol.
Thank you very much, Mr. Chair. The Treaty Policy Working Group has, of course, been working on these issues with the OECD and more recently with the UN for about a decade now. And so we wanted to offer some general comments to start with to perhaps help frame the discussion today. And we'd like to start by talking about why we think there is a need for a clear PE threshold. This is not something, apparently, on which there is full consensus. In reviewing some of the other comments that have been filed, we've seen some remarks primarily from civil society that a clear PE threshold is dangerous because, businesses might apply it and wind up without a PE. And that is, of course, not a perspective that our group shares. We think that there is a need for a clear PE threshold for both business and tax administrations, and that it needs to be clear, it needs to be certain, and it needs to be administrable. It has to be something that everybody can apply. Businesses, of course, need to know in advance what their PE status is in a particular country so that they can understand and comply with their tax obligations. I think that should go without saying. Tax administrations need to know what the PE standard is, the threshold is, so that they can administer their tax treaties properly, consistently, and efficiently. Everybody needs to know what the PE threshold is to avoid double and multiple taxation because PE controversies are increasing already, and they're particularly difficult to resolve. The function of the PE threshold, of course, is central to the operation of tax treaties. It's relevant not only to Articles 5 and 7, but also to Articles 6, 10, 11, 12, 13, 15, 21, 22, 23A, 23B, and 24, for starters. So that's a good piece of the tax treaty. And if we don't know whether there is a PE in a particular case, then all of that is open for disagreement and controversy. In terms of compliance issues, businesses that are seeking to comply with their obligations need to know where to file a return and where to pay their tax. They need to know whether to claim double tax relief in their residence state, whether to withhold tax, and this includes not only corporate tax but employee payroll tax, whether they have tax and financial reporting obligations, registration obligations, whether they need to set up books and records and accounting systems to track profits and expenses that are attributable to permanent establishments. And in some countries, they need to know whether a VAT obligation will be asserted in connection with the existence of a PE. The consequences of not having this threshold made clear up front for businesses are that they can easily incur substantial interest charges, civil or even criminal penalties in some countries, loss of associated deductions, an indefinite extension of the statute of limitations if they've not filed on the understanding that they don't have a PE, accounting issues, and increasingly negative press, other reputational risk, and even legal action against directors and executives. So it's quite troubling to business not to know whether they have a PE in a particular case. For tax administrations, I would submit that there are also some serious consequences. You could wind up with either underreported or overreported profits, increased claims for double tax relief, inconsistent application of the PE provisions to similarly situated taxpayers, which is never a good tax administration practice, increased controversies with taxpayers and with each other, and loss of treaty benefits that your country has negotiated if the partners don't apply the same rule reciprocally. Our basic concern, our first concern about the current options, is that none of them really is clearly articulated enough to provide this clear, certain, and administrable threshold. And we're not sure why that is. Is it drafting difficulty due to the compressed timing of this project? That certainly would be understandable given the timeline on which this has proceeded. But we worry a bit that it might be due to a lack of consensus among the participating countries, or even a deliberate decision to try to avoid a bright line. There's been some discussion of that in past PE consultations. And we would submit that that is something that really should be avoided. We all need answers on whether there is a PE or not a PE. We need clear rules that can be applied with an adequate degree of certainty. And if we don't resolve this, at the end of the day, the treaties will operate to create an impediment to international trade and investment rather than promote such trade and investment. So our basic ask here today is for development of clear threshold concepts for permanent establishments. Thank you very much.
Thank you very, very much. I think this... Is this Michael Scharf arriving? Yes, well, you've timed your arrival extremely well, because you're next up, according to the agenda. So welcome to you, and I'll give you a moment to pull your notes out, and then you're on.
Thank you very much. Sorry for being late. Well, first of all, thank you for granting me the opportunity to give some words on our thoughts on BEPS Action 7 and the actual draft. I'm working with Rödel & Partner, which is a consultancy firm having about 40 subsidiaries in different jurisdictions. And our clients are mainly from the German Mittelstand. So this is multinational enterprises, mostly family-owned, and having their headquarters in Germany. And for us, this BEPS Action 7 is a very, very big issue. Well, having a look at the aim of Action 7, it says that the definition of a permanent establishment must be updated to prevent abuse. It is said that enterprises replaced existing arrangement under which the local subsidiaries traditionally acted as a distributor by commissionaire agent agreements with the resulting shift of profits. Yes, we think in some cases this is true. Nevertheless, we observe a lot of cases where the reasons are not tax reasons for implementing such commissioner models. So we believe there is a high risk that the approach we discussed today might exceed the aim of BEPS. So the economic reasons, I want to highlight some economic reasons why we implemented commissioner models. Very often when we have smaller local businesses, it's not efficient for clients, and we observe that very often to implement a fully fledged distributor. In those cases where we have 3 or 4 or 5 salespersons, it's not needed to have a full-fledged administration, but nevertheless the customers very often ask for contracting with local entities. That is one reason why commission agent models were implemented. Additionally, we observed that unstable revenues For example, in industries where we have a high volatility of turnovers due, for example, for project businesses, can help to mitigate the volatility of profits and to make transfer pricing much more easier. The same is with unstable market prices. We very often observe that products are sold in one market but in different industries, and these industries lead to very high differentiation in the market prices for the same product. So it's hardly possible to find transfer prices using a traditional method like resale minus to determine unreasonable transfer price. So this commission model would help to make things easier. And nevertheless, transfer pricing itself is one aspect why commissioner agent models were implemented. Instead of determining a total price or an appropriate transfer price for each product, there is the need just to determine one appropriate commission fee. This helps especially smaller entities to reduce their administration burdens. And last but not least, we do have a lot of clients who have implemented commission agent models from the very beginning of their business. There was no restructuring, and we observed that in the overwhelming majority, the reasons for implementation of commission models were not tax reasons. So we fear that the new definition of the permanent establishment would have a big negative impact on our clients. So what would the result be of a permanent establishment due to commissioners? Well, we have already necessary, if we are within a group of entities, that we have to find arm's length remuneration for the commissioner. We have to document that. And in the future, additionally, we might have finding an arm's length profit of the permanent establishment and additionally a documentation on that. So this means for our smaller clients and mid-sized clients a very high burden, and this might risk that they will not go to some markets because the efficiency and the profitability of the market will be sucked by administration expenses. There are some additional risks we fear. So we raised the question if a permanent establishment is created, whether there is a shift of something of value which might lead to a taxation of hidden reserves, and if the requirements of the PE are gone because maybe we have another principle we do business for, well, there is the way back, and maybe we have again a taxation of hidden reserves. Additionally, we fear that now there is an intention to have a distribution profit at all. Compare that to a commission agent model, or compare that to the profit of a local sales entity, and the difference need to be taxed as PE profit. Also, all functions normally in that structure are rendered by persons. So we think, yes, there are some cases where the commission agent model was used to have an abuse, but nevertheless, we believe the nexus of taxation shall be at the level of the sales entity and not additionally on the level of the principal. And we believe there are some alternatives how we can achieve that by having a look at transfer pricing aspects. The OECD guidelines mention that a basis for finding appropriate arm's length remuneration is a function in risk allocation, a value chain analysis, and if we actually compare commissioners and see that they have functions and risk quite closely to that of a distributor, we wonder why there should be a differentiation in the profit. And actually, we do have clients who already do benchmark studies for the commissioners abroad by comparing the profits with distributors and adjusting just working capital. So there is no shift of profits intended at all. And I think we can use the existing rules to prevent such a shift. If there was a restructuring, I think we could also ask the question whether third parties would accept such a change. So that means third parties generally would accept, as a sales entities, a reduction of their function to commissioner if they won't lose too much profitability on that, if they own the intangibles like the customer bases. So I think there are possibilities to prevent the abuse of commissioner models by existing rules, and maybe it makes sense to rethink about a more distinct or concrete definition or assumptions, requirements for recharacterization of sales models. If a structure seems to be artificial, maybe there is the possibility by clarification on the possibilities to recharacterize the business relation. So to say at the end, we generally have no problem if we replace the word conclude contracts by engage specific persons in a way that results in the conclusion of contracts. This is indeed very often observed by us also as a means for avoiding a PE, but we would really be happy if there won't be a change toward that independency. Thank you very much.
Thank you very much. It's now time to open the floor to for general comments. Just a reminder that the way to attract my attention is to put your flag on its end. I know some of you, but not all of you. So if I don't call you by your name, it either means I don't know, or I've forgotten, or my eyesight isn't quite good enough to reach the far end of the table. And it certainly isn't good enough to reach the writing on the name tags at the far end of the table, so I may just end up gesticulating, so apologies for that. When you do take the floor, please introduce yourself, say slowly and clearly what your name is and your affiliation is, and that will help everybody. So I open the floor for general comments, please. Carol Doran-Klein.
Yes, thank you, Chair. Carol Doran-Klein with United States Council for International Business. And I wanted to follow up on a point that Carol Donahue made that I think is extremely important, and one that the USCIB comment letter reiterated throughout, which is the sorts of procedures that a company has to put in place to, once a PE exists, are expensive. And if it isn't clear whether you have a PE or not, and you don't expect a lot of profit from that activity, then you will definitely reduce that activity to avoid those costs. Not just the tax cost, but more importantly, the financial cost around establishing all those accounting, all those accounting systems. So it's very important that the thresholds be clear, because if it's going to cost me $1 million, and multiple members told me that these expenses can run into multiple millions of dollars, then you will do your best to avoid that status.
The lady in the corner.
Thank you. Good morning. My name is Stella Raventos, and I represent here the Confédération Fiscale Européenne, which represents thousands of European tax advisors. While CFE is very grateful for the chance to participate in this discussion, we must say that if what the paper sought was certainty in establishing the threshold for a permanent establishment, I'm afraid the paper has not reached its goal. Quite the reverse. For what we believe taxpayers and tax advisors need is clarity. And this paper is far from clear. On the one hand, we have the title, Artificial Avoidance. We do not believe all cases explained here are artificial avoidance or abuse. The paper widens the scope of the permanent establishment, not just tackles artificial avoidance. And this is very important for us, to seek clarity in all cases of permanent establishment, because you mentioned the losses of the companies, whatever. Of course, business are worried about that, and tax advisors also, because we face responsibility in front of our clients. If we have to talk about the commissioner arrangement, we think that, again, it's not very clear. We don't favor really any option, but if we are forced to, we believe option B is less uncertain, because options A and C really create a lot of confusion around the permanent establishment. Also, even if we choose option B, we think more clarification is needed, especially regarding some words such as material elements of contracts and similar arrangements. Thank you.
Thank you. Sol Picciotto.
Thank you, Mr. Chairman. I'm Sol Picciotto from the BEPS Monitoring Group. I guess we represent civil society in a way, although we're a network of tax specialists similar to the previous one, but sponsored by a number of tax justice organisations. In fact, we really agree with the general principles that have been mentioned by some of the previous speakers, for example, Carol Donoghue, and I was a bit surprised to hear from her that civil society isn't asking for clear principles. That's exactly what we think should be done. We think the problem really is because of has already been identified by Lieselot Kana, the difficulty of reaching consensus and therefore the rather tentative approach adopted in the draft. The real problem here isn't the type of agent that a company which is exporting might use. The problem is the ability of internationally organised corporate groups to fragment their activities so that although they may have affiliates in a jurisdiction, those affiliates aren't attributed the activities which really generate the profit. So it's the fragmentation problem. But the paper starts by addressing the issue of agency, and only later gets to the fragmentation issue. And then the proposals on fragmentation are really rather limited, and in relation to the exceptions. What we would say is that the issue of fragmentation ought to be addressed head-on by looking at paragraph 7 of Article 5, but that seems to be excluded. The mandate for this action point seemed to be rather limited, or it wasn't very clear whether it did involve re-examining the permanent establishment definition. It was said that it was only about tackling abuse of permanent establishment, but that actually led to the problem of lack of clarity that the business side, quite rightly, I think, is pointing to. That if you don't address the issue of definition of the permanent establishment, but you kind of try and tinker with it, you will reach lack of clarity. I was interested also, Will Morris said that any change in the definition of permanent, or any change, amendment of a permanent establishment, inevitably affects the balance of taxing rights between resident source jurisdictions, and that ought to be faced head-on. Again, we entirely agree with that. So the problem is that the Working Party has been hampered by having apparently a rather moderate mandate, a rather modest mandate. But now this Working Party is only part of the whole BEPS Action Plan. And we know that in the background there's Action Point 1 on digital economy. And the report we had from that examined various issues about, including the definition of permanent establishment and the possibility of needing a more modernized definition of permanent establishment for the digitalized economy. And the conclusion was it's not a separate section of the economy, but digitalization of the whole economy, with which we agree. But then that issue has been deferred by Working Party 1 to see what the outcomes of the other BEPS action points are. Now, if this action point really comes up with these rather modest tinkering definitions, we will be caught really changing horses in midstream. We will end up with a kind of tinkering and lack of clarity that business side has complained about. And in the meantime, then, we'll have possibly further work done under Action Point 1, but also we will have other individual member states of the OECD going their own way. The failure to get a consensus in the OECD doesn't stop other countries introducing their own measures. Some already have. Some have measures in place that go well beyond what is proposed in this. And as we know, some have just introduced it. My own country, the UK, everyone knows. I hope there will be some discussion today of the diverted profits tax. But that, I would have thought, is far worse from a business point of view than this, because on the one hand, it has a more extensive PE definition in relation to contracts than is proposed here. And on the other hand, it is even more unclear because it introduces anti-abuse notions. I saw in some of the comments the notion that maybe this can be dealt with through anti-abuse provisions, but I can't see how anti-abuse provisions fail to clarify it. So really, to summarise, it does seem to us that there does need to be a re-examination of the permanent establishment definition that should focus really on Article 5.7, that where an internationally integrated company already has affiliates, so we're not talking about the terrible pain of if you don't really do much business, you're a Mittelstand company. I entirely sympathise with that. If you're a relatively small company, not doing very much business in a particular jurisdiction, you don't want to have to cross the permanent establishment threshold, that's fine. We're talking about internationally integrated companies that already have quite often related activities in a jurisdiction, so they're already registered for VAT, they have employees, they do all that stuff, but by fragmenting their activities, they avoid attributing a permanent establishment to the activity which actually is the big profit generator. Unless you tackle that, you won't resolve the problem with a clear and modernised permanent establishment rule. Thank you very much, Mr. Chair.
Thank you. Gary Sprague.
Thank you, Mr. Chair. My name is Gary Sprague. I'm representing the Software Coalition. The Software Coalition is a group of 24 companies in the software and e-commerce sectors, principally but not exclusively U.S.-based. The Software Coalition, I think, has some special expertise to bring to this discussion because Software Coalition members do indeed use commissionaire structures quite regularly. Indeed, commissionaire structures are used by our clients not only in the software industry but in other industries as well. And so I personally have probably drafted dozens and dozens and dozens of commissionaire agreements, and I think I have a pretty good sense as to how those commercial relationships work as a matter of law, and I'm grateful for the opportunity to be able to discuss some of those nuances with you. I do have some suggestions as to possible improvements to options A to D to focus particularly on commissionaire structures, but I'll reserve those comments until we get to that topic. For this section of the general comments, I'd like to just say a few words about how commissionaire structures work. First, I'd like to endorse everything that Mr. Sharp said about the commercial reasons for adopting commissionaire structures. When a client comes to me about investing in Europe, it's a very typical conversation for me to say, you have three choices. You can sell, or four choices really, you can sell through completely unrelated parties. If you want to go through the direct channel, i.e. using your own entities, you've got three choices. You can set up your local entity as a buy-sell reseller, you can set up your entity as a commissionaire, or you can set up your entity as a disclosed sales agent. The three relationships have three very different commercial consequences, and the commissionaire produces business efficiencies of various sorts. Mr. Scharf has mentioned several of them that many of our clients appreciate. It centralizes all inventory in the central selling entity, which means inventory financing is easier. It centralizes accounts receivable in a central entity so that foreign exchange management is easier, and just revenue management, credit collections management is easier. So when you ask companies why they adopt commissionaire structures, there are significant business efficiencies that, if the company wants to pursue the centralized model, will cause them to adopt commissionaire as opposed to distributor. For that reason, I do think it's inappropriate to refer to the choice of commissionaire structure as an artificial avoidance of PE. I fully accept Lieselott's comment that something must change, and if something will change and it's in the commissionaire area, I'll have some comments later, as I said, as to how best to accomplish that. But it would be indeed a change in the balance between the rights allocated to source states versus resident states, not a prevention of an artificial avoidance of PE. I do note that the paper itself described two reasons for the OECD to take some action in this area. One was a hypothetical where a group may have restructured a prior buy-sell arrangement into a commissionaire arrangement, and the second was the normal application of the transfer pricing rules that compensated the commissionaire for the functions it performed, and the paper concluded that the transfer pricing result produced too small profit allocation for the commissionaire entity. I submit that neither of those issues is a PE issue. As I think everyone in the room knows, the OECD has done quite a bit of work over the years on business restructuring, and we now have a chapter in the transfer pricing guidelines dealing with business restructurings. And if there is a business restructuring of the sort described in the paper where the distributor disposes of valuable assets, then that's a recognition transaction that needs to be recognized for tax purposes. And on the transfer pricing side, the paper says, well, the commissionaire is not rewarded for having inventory or other assets, and that, I think, is just true. Commissionaires don't carry inventory. They don't have those assets, and as a matter of transfer pricing, well-accepted transfer pricing principles, the Commission doesn't reward the commissionaire for that. So as we go into this exercise, I do think it's appropriate to acknowledge that the choice of a commissionaire structure is one of several commercially available structures that companies may choose. I personally have looked back to the legal history of commissionaires back to the German Civil Code from 1890. I noted the International Tax Group stated that the civil law antecedents of commissionaire statutes goes back 600 years. Obviously, someone there has looked at this in even more depth than I have. But these are well-established commercial relationships used between unrelated parties in many sectors, including international trading companies. So as we look at these transactions, my first comment as a general matter is we need to respect the choice as a legitimate commercial choice of groups. The second is to the extent that this really is a transfer pricing issue, which is all the paper described as the reason to do work in this area, let's acknowledge that and look at the transfer pricing aspects and don't necessarily jump to a PE solution. Thank you.
Thank you very much, Gary. Carol Donoghue.
Thank you very much, Mr. Chair. I just wanted to clarify my earlier remark, since Professor Picciotto has asked. I wasn't actually thinking of the BEPS monitoring group comments when I said that there are groups that have advocated a lack of clarity. There are other things I would take exception to in your comments. Of course, I don't think we ought to work toward a disregard of separate legal entities and abandon the the separate accounting principles quite yet, if we're going to continue to apply the arm's length principle. But for example, there is a remark in the Global Financial Integrity Group's comments that supports the use of overarching principles rather than specific rules. And the rationale that they provide for that, I'll read one sentence just to make clear what our particular concerns here are. If I can find it again, here it is. Oops. Apologies. I had it just a minute ago. It's just hard when you're dealing with 835 pages. I don't envy those of you who are trying to keep up with all of this. The sentence that caught my eye says, business likes very clearly defined requirements in laws and regulations because A, it is easier to know whether you are in compliance or not, and B, because that makes it easier to find alternative approaches or structures that are not in violation. The more conceptual or substance-based laws and regulations are, the more individual judgment businesses must apply if they are considering straying from known approved approaches to that law or regulations application. Our basic concern really is that we just need to know what the rules are. And so that we can comply with them. We are concerned about comments that suggest that not having a PE everywhere, we have a customer, is necessarily an avoidance case. I guess perhaps we are traditional, but we think that the PE standards are really intended to operate as a threshold to facilitate cross-border trade and investment, and not as a magnet to attract additional revenue. Thank you.
Thank you, Carol. Sol Picciotti.
Thank you, Mr. Chair. I was interested in the comments from Software Coalition and the implications of that. The implications seem to be, well, these legal contractual relations go back a long way and they're widely used by small business, Mittelstand, etc. So we should respect those legal, but there's then the consequence that we should also respect that if it's a choice by multinational company groups. And I think that that's really the unacceptable step. That they are two very different contexts, and I don't think it's right for multinational corporate groups to hide behind small business and to say, well, it's a valid choice for small business if they're not doing much business in a jurisdiction, they don't want to have a P, they don't want to set up registration for VAT, employment, all this other stuff. Absolutely agree. But then to say, well, then it's a valid choice also for a multinational company group when that group already has affiliates, when that group is already registered for VAT and all the rest of it. I mean, it doesn't seem to me to make any sense. That's really the problem. What we heard earlier, for example, is that one reason for choosing it, and I thought it was again in the small business context, was of the difficulty in finding comparables. Absolutely, yes, and it's a problem in the transfer pricing area. And that's also an area where we do need a more full-on examination. Now, we already have in Article 5, or Article 7 rather, in most international treaties, the possibility of using an apportionment approach. So if there is if there are problems of applying the classic arm's length principle based on comparables, and the possibility of apportionment has always been there in the treaties from the beginning, precisely to deal with this kind of a situation. And although the OECD abandoned that possibility, it hasn't been implemented in very many treaties. So I entirely agree that this is again linked to the difficulties of transfer pricing. That doesn't mean, again, I come to the point, that doesn't mean that where a multinational corporate group has related activities, we're not talking about a group that maybe operating unrelated activities, we have quite a good anti-fragmentation definition, I think, in the paper, but that should be applied as a test. If we can change the presumption in Article 5.7 to a presumption that where you do have a related entity, the presumption is that it is related, but you can apply a test as to whether the activities really are related. That's really the question. The question isn't where small business has a valid choice as to whether to how it operates within a jurisdiction.
Thank you very much. Are there any other comments, please? Gary Sprague.
Thank you. I'm happy to elaborate a little bit in response to Saul's comment. I doubt the OECD would want to make a distinction between choices of commercial structure available for small business versus large business, but let me give an example of the commercial efficiencies of the commissionaire structure for large businesses. We'll take as an example a company that's selling tangible goods, and they've got a centralized warehouse in a couple European countries, and let's assume it's a business that requires demonstration equipment to demonstrate the product to customers and spares that need to be swapped in and out. If that company ran a distributor model and all of those assets had to be owned by a local distributor, if you had an inventory in France and you needed to supply it to a customer in Germany, you'd have to have an intercompany transaction between the French entity that held the inventory and the German entity that had the customer relationship. And if you can imagine a centralized model with inventory only in a couple locations and spares scattered all around Europe, that creates vast numbers of intercompany transactions. The commissionaire model concentrates all of those assets into a single legal entity so that if a spare part is located in Denmark and you need to send it to Poland, there's no intercompany transaction at all. You just send it. And those business efficiencies are tremendously valuable to business. And I would submit those sorts of efficiencies are even more important to big business than small business that may be focused on all of its operations with respect to customers in a single jurisdiction. So it's those elements of the commissionaire structure that create the attraction of the structure to business. I'm putting aside all the discussion of whether we ought to make it or you ought to make it a PE. I'm just observing that these structures are adopted by companies due to true business efficiencies.
Thank you, Gary. Mary Bennett, please.
Thank you, Mr. Chairman. I'm Mary Bennett, here today on behalf of the International Alliance for Principal Taxation, which is a group of 20-plus multinationals from many different countries and industries around the world. And the point I wanted to touch upon as part of this general discussion has to do with profit attribution. And I know that is an issue that is identified as part of the action plan, and this particular action item as something that should be considered in deciding upon a new definition for permanent establishment. I believe this is a theme that we will return to in the course of the day on many of the different options under consideration, but I just wanted to tee it up at the beginning of the day to make sure that it's in everybody's mind, in the sense that I think anytime you're considering a change in the PE definition, you want to ask yourself at least three questions. First of all, have you thought about the profit attribution implications of the particular new type of PE that is being considered? If you've thought about them, is there agreement among the governments on what the profit attribution approach should be to that type of PE, and what the rules are going to be? And are they sufficiently, is there guidance that's sufficiently reliable to allow a determination of profit attribution that won't result in a lot of different disputes by virtue of the creation of this kind of permanent establishment. And lastly, if you can answer those questions affirmatively, the last question I think you would want to consider is the result sufficiently material to justify the added administrative costs and burdens on the part of both business and governments of having that kind of permanent establishment be one that will trigger taxing jurisdiction. And I have to say, I think on a great number of the options that we're going to be talking about today, those are questions that should be very high in the minds of the people thinking about this, and it's not entirely apparent from the paper that's been put out whether those issues have been fully considered by the subgroup or Working Party 1. And of course, this is an area where there's likely to be a significant need for coordination between Working Party 1 and Working Party 6, and the time is short to get all of that done. But I think what would be important would be some assurance that those issues are being fully considered and not being left to a sort of footnote at the end of the report. Thank you.
Thank you, Mary. Are there any other comments, please? Yes, please.
When I read the draft the first time, I had one thought. This Action 7 is abuse preventing thought, and if I want to prevent this abuse by creating permanent establishments, I have to keep in mind to which extent actually an abuse has been taken place. So it's not only then the discussion of the profit of the PE itself. I think we then have also to keep in mind what is the actual profit of the commissioner, and was there an abuse or not, so that the profit of both have to be considered in order to find an appropriate profit of the PE. And then there's another aspect I want to add. When we are within a group of entities, there's very, very often the situation that the sales entities are exclusively selling for the total group of entities. And if we now assume that in all cases where we are a commissioner and just dealing for one principal, this would lead to the result that more or less all commissioner models of M&Es will create permanent establishments. And well, again, if there was no intention to abuse or to erode the tax basis, I think that there will be tremendous additional work for multinational enterprises, also they try to act fairly.
Thank you. Johan Muller.
Thank you, Mr. Chair. Just as an introductory remark, I'm probably of the minority school that believes that the OECD did the PE article from start to day, they would have worded it in such a way that commissioners were PEs. I do, however, agree with Mary Bennett. I think the biggest issue is not whether there's a PE or not, but it is what is the profit of that PE. And as the paper is at the moment, there's not a lot of guidance on that, but there's a lot of surrounding guidance which I think we can borrow from. One, the new Chapter 4E on safe harbors. There we go extensively into contract manufacturing. We go into limited risk distributors. And we say that these are simple routine transactions for which we actually can create safe harbors. Why not here as well? In the paper on intercompany transactions, we create safe harbors for certain intercompany transactions. If we call these limited risk distributors, commissionaires, and contract manufacturers simple routine functions in the safe harbor paper, which has been adopted already, why can't we do it in the intercompany service transaction paper as well? I would also say, and I've said this in my paper, I don't think the solution of Chapter 4E, which would be a solution for the issue raised by Mary, by doing these agreements bilaterally would work. It will take forever, but we are working on a multilateral instrument. Can we build some safe harbors into something like that? And then I would simply end with saying that I really think that the AOA, as it is at the moment, does not give guidance on this. And my issue particularly is if you take a sales PE or a commissionaire, whatever you want, I don't see the guidance in the AOA which says when I have to look for whether there is a function in the PE that actually manages debtors' risk, or whether there's a function in the PE that manages inventory risk, or anything like that. And what I've seen in a previous position on intergovernmental discussions on when there is a PE is that it's always difficult to come back to, well, if there is a sales PE, what income do you allocate to it, because you don't see the functions. And if anything, I think the AOA is a little biased towards allocating functions to a PE when there are no people dealing with those functions. Thank you.
Thank you. Will, is it you behind the BEAC flag?
Well, I wasn't, but I am now. I'm going to hand over to Karl-Heinz in a second. I just want to come back on one of Johann's points, though, because I think it is quite important. And while I often agree with Johann, I don't on this particular occasion, which is I actually do think it's very important that we look at the question of when a PE is created or deemed to occur as well. And for the very simple reason that once a PE is found, then all of the attribution issues, all of the TP issues become considerably more complex. And one of the things that we're trying to do with this, and I mean, Sol has alluded to this as well, and you know, there may be reasons for not liking clear rules, but there are lots of reasons for liking them. And therefore, I think if we have a sufficient gateway test and brighter lines, wherever you draw those lines, just to be very clear about that, wherever you draw those lines, you can change them by all means, but draw them clearly so that you know when you're in a P and when you're not in a P. I think that's very important because I think essentially if you said, look, everybody's a PE, and then we'll figure out the transfer pricing, the number of disputes is going to balloon, and I don't think that's where any of us want to be. So I think a focus, as this project does, on the qualification for a PE remains an appropriate focus. As I said right at the beginning, there are attribution issues which also have to be dealt with as part of the puzzle here. But I think to draw away from the issue of whether the creation or not of a PE is important, I think would be a mistake. Let me leave it like that. I am now going to hand over to Karl-Heinz, however, who has a word to say about VAT.
Thank you, Will. Good morning, everybody. As we are in the general comments section, I thought it's a good point to make a couple of remarks on aspects which are not related directly to direct tax, and I wanted to cast a little bit the picture on the thoughts on the broader picture, because all the action items of the BEPS initiative have of course also impacts on other, or can have impacts on other taxes like VAT in particular. And as we all know, we are living in different worlds, often in the tax arena, in silos, and it's very, very important to actually bridge these silos and look at things from an overall perspective. And I was very glad to hear before that VAT was mentioned here and there. And I think that's very, very important to look at things also a little bit what it means for VAT. Yeah, I think it is clear that, as you all know, the definition of permanent establishment for corporate tax purposes and fixed establishments for VAT purposes are not the same. But of course, if we are coming to more PEs for VAT purposes, for corporate tax purposes, we will also end up with more VAT registration, was mentioned before. This means, of course, additional compliance burdens. We have to look at ERP systems changes. We have to look at the different invoicing system and at audits. This all creates costs. And then I think what is very, very important as well, actually to understand this kind of our actions can also have impacts on the collection mechanism. Quite often, if a foreign company has a branch in a different country and then actually supplies activities which are not related to the branch, for example, services directly from its head office to another customer, they are actually sort of, tracked by the force of attraction rules. which means then you have to actually run everything which you do via your branch. And at the end of the day, this causes for the supply chain and for all the business decisions quite a big complexity. And in addition, I think what is very, very important as well to understand, this causes also big mismatches then on the returns of the PE between VAT and direct tax purposes. And we have seen that in the past that this actually, especially in audits, creates a big, big nightmare for businesses to make clear why there are differences. And I think that's something which is very, very important to understand as well. Again, what is very, very important is that the increased risk that conflicting establishment definitions for VAT create double taxation and non-taxation. And now, of course, we know that we have on the VAT side this project on the international VAT GST guidelines, and we do hope that actually with moving this forward and making sure that the principles are hopefully applied consistently all over the world, this would actually help things. But again, these are aspects which we need to look at both from VAT purposes and from a direct tax perspective, which I wanted to highlight. And then finally, just quickly, it is actually a corporate tax issue which arises out of a VAT issue. Quite often businesses are merely VAT registered in another country to actually collect the VAT for the government. And quite often we see now tendencies that a mere VAT registration leads suddenly to a corporate tax PE. And then actually this discourages then at the end of the day the honest taxpayer to collect the VAT by being dragged and squeezed actually on the direct tax side for something which he wants to just do because it's his obligation to do. And I think these are aspects which we also want to make sure that is considered when we're speaking about a permanent establishment and VAT registrations. And then I think the point was made before whether foreign businesses could not use VAT registrations of their local affiliates. Now, we all know that VAT is a legal entity-based tax, a transaction-based tax, so I cannot just use a VAT ID number of another affiliate. I have to sell them through this affiliate. I have to actually totally change the way I do business in order to make sure I can handle things that way. I think that's very, very important to understand as we're speaking in VAT with a transaction-based tax based on legal transactions. Of course, we can always use only the number, the VAT number of the seller of the entity which is involved in the transaction. I think that's all from my side. Again, there's a bigger picture to that, and I'm very, very happy that with the OECD and VAT GST work we are starting there, that we are trying to bring these silos together. And I would also encourage the direct tax colleagues to reach out to the VAT colleagues in the governments to reconcile on these aspects too. Thank you.
Thank you very much. Are there any more comments, either from country delegates or from business colleagues and others? I don't know whether it's possible to bring forward coffee. Is it possible? You'll go and find out. Okay. It's usually one of the things that can't be moved. I'll just wait for that.
Sure. Yeah, I'm tempted to ask a question to Mr. Picciotto about this reference to 5.7. I'm not sure I got that. I've heard from other people that one thing we should have proposed was to delete 5.7 so that if you have a multinational that has a subsidiary, it has a PE in the state. And I'm not sure whether you were referring to something like that. I struggle to understand what it would do. Because if you have the subsidiary, it's already taxable in the country. What you do through the dependent agent PE is that you attract some risk or ownership of assets in a deemed PE, and that I can see the logic of. But just having a rule that would say the moment you have a subsidiary, then the rest of the group has a PE, I just fail to understand what it would do, how it would work, and why anyone would think that this would be a solution.
Please.
Yeah, but, as I say, I think the issue isn't really a PE. The issue is once you have a taxable presence, what are the activities attributable to that entity? And I think the problem with Article 5.7 is that it allows you to categorize the activities in affiliates in one way and then to say, well, they must be treated as completely unrelated to other entities within the group. Now, the only way that countries at the moment can pierce that is by attributing a PE to one of the other entities, and then you get the problems of transfer pricing. As I say, what we would suggest is not deleting Article 5.7, but reversing the presumption in Article 5.7, so that then if you do have a related entity, then there is a presumption that the group as a whole has a taxable presence. And then the taxable presence extends to all related activities. You already have in the draft, I think, a workable, although probably we'll discuss it this afternoon, anti-fragmentation rule. So the anti-fragmentation rule that you propose, or a similar one, could be applied. So then obviously you do get into the transfer pricing area, which obviously lurks behind this. Now, as I say, what we would say is that, again, in the transfer pricing area, application of the strict arm's length principle, treating every entity as if it were completely independent, doesn't work. You do need to move towards apportionment principles. So it is a problem both of grasping the nettle of taxable presence once you have a taxable presence, and then going to the profit attribution rules. And the most appropriate method of dealing with that, and we've made our separate submissions on in the transfer pricing area, in our view, is to move towards profit split approach. So there are the two related issues. What does it mean once you have taxable presence? And secondly, what profits are attributable to that taxable presence? And the two really can't be dealt with by tinkering. The basic problem is the separate entity principle has been carried to a ridiculous extent. Article 9 is actually about the power of tax authorities to adjust the profits of related entities if they don't seem to reflect a fair attribution. Now, unfortunately, then uses the notion of treating them as if they were independent. But that was never meant historically. If you look at the history of Article 9, it was never meant historically to mean that you must treat every separate entity, every separately incorporated legal entity, as if it were independent, and always apply comparables. That problem has been shown repeatedly to have failed. That approach has been shown repeatedly to have failed. So you need to, on the one hand, to grasp the nettle of taxable presence, which does mean then that a multinational group may well have a taxable presence, but in circumstances where small companies would not. And then the question is, what profits do you attribute to that entity? And that is also a nettle that has to be grasped. And that does mean looking at the transfer pricing rules of profit attribution. Now, those really are the central questions in the whole BEPS project. And in the second year of the BEPS project, increasingly we're coming up against that, not only in this action point, but in all the ones on transfer pricing. And unless we tackle that, we're going to create much more confusing rules. In the transfer pricing area, the proposals really are increasingly both complex, difficult to understand, and contradictory. So there are some nettles to be grasped here. And I think, as I've said, we entirely agree with the principles that business is asking for. We need clear principles. But you really can't reach clear principles by tinkering at the edges of the problem. If you start on uncertain ground, if you start on the ground of saying that an internationally integrated corporate group actually must be treated as if it were a fragmented set, which, as we know, is often of hundreds of affiliates, then the tax system, the international tax system, will never reach clarity, and we will have increasing conflicts, and the conflicts will be both between taxpayers and tax administrations, and amongst tax administrations.
Thank you. Yes, please.
Thank you, Chairman. Yes, I think Professor Picciotto has pointed out what the real problem is. We have been working with a separate approach for years, since the 1963, and we discarded, what the OECD discarded at the time, the global apportionment system. Now it looks as if we all have more or less realized that with the separate approach, the separate companies approach, we can't go forward, especially, and this is a valid, probably also a valid difference in the case of big multinational groups. But what we can do is just trying to reach the global apportionment objective by way of strange paths, such as changing or broadening the PE concept, which is what we are doing here, not just preventing artificial avoidance, but considerably widening the scope of the PE and with the transfer pricing methods. This is important because probably many people here have, in my view, some right points. Mrs. Bennett's point is that is completely right. Point E of the proposed paper is probably the most important. Once you have verified or checked or reached the conclusion that you have a permanent establishment, how do you tax it? And the thing is that justified in terms of a transfer pricing analysis in the case of small companies? It may be justified in the case of big multinationals to apply all different methods to all kind of supposed permanent establishments we have. But in the case of small companies, is that justified? I think Professor Picciotto is right. We are faced with a, how could I say, a limit problem, and that has to be solved. But if we want to go ahead with the separate approach, then it's very important to have very clear definition of PE and then stick to it. Maybe in the case of artificial avoidances of the threshold, resort to the abuse institution, or just to stick to it. But we can't have the worst of everything, the worst of global apportionment and the worst of the PE and the separate approach. Thank you.
Thank you. Michael Wickman from Germany.
Thank you, Mr. Chairman. Well, I would like to make a cautious remark regarding the issue of integration that was brought up by Professor Picciotto. I don't think that this would necessarily be a question of 5 paragraph 7, but probably more an issue of Article 5 paragraph 4. To come back to the issues that we have touched, what we have to see is that there has been a development, a change in business structures from parallel groups where you have all the full set of functions in each jurisdiction to integrated groups where you centralize functions. And against this background, I think it becomes clear that if you centralize a function, this function in the overall context of the group activity may increase its weight, its functional weight, regarding the threshold of auxiliary and preparatory activities. And therefore, if you have a centralized warehouse from which you deliver tangible goods, and if the market conditions ask for fast delivery, same-day delivery, which may become a key function in competition, then I think it is justified to re-evaluate functions and regard something which in the old days, in the parallel structure, was auxiliary and preparatory, to be now a core function. And therefore, I think the flexibilization of the interpretation of paragraph 4 of Article 5 might be a more appropriate way to take up the issue of integration rather than discarding paragraph 7 of Article 5, because the separate entity principle really is the absolute basis for the arm's length principle. And if we do away with that, we will be lost. On the other hand, it has to be admitted that the benefits of integration have always been the most difficult part of transfer pricing, and that had already been flagged in the transfer pricing report of OECD, that this was an issue how to attribute the benefits of integration. And therefore, for us, the issue of 5 paragraph 4 is a very important issue. But I have to admit that the German view was that what is mentioned in letters A to D was always and already under the assumption that it was preparatory and auxiliary, and that in the individual case you could rebut this assumption. But now this was not the majority view, and therefore that was the reason why there's a proposal to change the article. And although, of course, this may give rise to discussions and unclarity, I think this is still the best way in order to keep the principle of permanent establishment applicable under modern conditions. Thank you.
Thank you, Michael. You've taken this very nicely. Right, let's begin, please. We're now moving on to the proposals that we have made, which are listed as proposals A to D, these alternative methods of addressing Article 5, Paragraph 5 and Paragraph 6, what we've called the commissionaire structures, the thing that one of the first things the action plan asked us to address. And so we've got three speakers who are going to make some remarks on that, and then as before we will throw the floor open to comments. And the first one is Catherine Schultz from the National Foreign Trade Council. Catherine.
Thank you. I'm Kathy Schultz from the National Foreign Trade Council. We represent 250 multinational corporations, both U.S. domestic and the foreign subsidiaries of foreign parents, so that my remarks are for the NFTC members in general. The NFTC supports the efforts of the OECD to maintain a model tax convention that reflects international tax norms. Among these norms are reciprocal and mutually beneficial limitations on source country taxation designed to facilitate and promote international trade and investment. We agree with all the other previous speakers that the permanent establishment standard is a critical element and that should provide source country taxation on its business profits unless the enterprise meets a minimum threshold of business presence in the source country. In general, the NFTC believes that the options proposed in the discussion draft overshoot the mark. The discussion draft proposes options to change the OECD model that are much broader than required to address the concerns identified by the discussion draft. We urge the OECD to consider a more equitable approach that better balances the historical objectives of the permanent establishment standard with the concerns identified by the discussion draft. The draft frames the BEPS concerns arising from commissionaire arrangements with an example illustrating the conversion of a local affiliate buy-sell distributor to a commissionaire, resulting in substantial reduction of profits of the local affiliate. The discussion draft considers this result inappropriate because, as a matter of policy, where the activities that an intermediary exercises in a country are intended to result in regular conclusion of contracts to be performed by a foreign enterprise, that enterprise should be considered to have sufficient taxable nexus in that country unless the intermediary is performing these activities in the course of an independent business. This policy conclusion is not justified or defended by the draft. The profits of the intermediary, which are based on the functions of that intermediary in the source country, are subject to tax in the source country. This results in the same whether the intermediary is a dependent or independent agent or whether the intermediary is an agent at all. The conceptual claim by the source country to some share of the profits of the foreign enterprise is not self-evident where the enterprise has no presence in that country. Indeed, a premise of the discussion draft is that the income of the foreign enterprise is not otherwise subject to tax. It is otherwise unclear why the home country of the enterprise should forego taxation or provide a foreign tax credit with respect to profits that are earned as a result of home country activities of a resident taxpayer. There are 4 options presented in the discussion draft. We agree with all of the previous speakers that each of these options is problematic. It is noteworthy that none of these options is limited to commissionaire arrangements. The arrangements cited in the discussion draft and BEPS Action Plan. There is no evidence that the policy issues raised in paragraph 7 of the discussion draft have been a significant issue outside the context of commissionaire arrangements. Indeed, to the extent commissionaire arrangements involve low-function principles, they may be adequately addressed by other parts of the BEPS project, in particular Actions 8 and 9. The OECD should consider a narrow option that is targeted specifically at commissionaire arrangements that have given rise to concerns. Moreover, each of the options presented is ambiguous and therefore subject to differing interpretations. For example, options A and C base a permanent establishment determination in part on whether a person engages with specific persons in a way that results in the conclusion of contracts by the foreign enterprise. The discussion draft suggests that the factual relationship must be a direct causal relationship, but does not provide guidance regarding the extent to which the relationship may be broken by activities of the foreign enterprise before the conclusion of the contract. The factual relationship necessary between the activities of the intermediary and the conclusion of contracts therefore is unclear. For example, would exploratory meetings with potential customers meet this standard if the negotiations of material terms was done by a foreign enterprise outside the source country? Options B and D, on the other hand, hinge on whether a person negotiates material elements of contracts. What elements are material in this context? What if some material elements are negotiated by the person in the source country and other material elements are negotiated by the foreign enterprise outside the source country? What if the foreign enterprise develops standards for material terms it will accept and negotiations in the local country involve persuading a potential customer to agree to such terms? Notwithstanding its perceived faults, the current dependent agent standard has the benefit of being relatively clear and is not as susceptible to such interpretive issues. Finally, it's impossible to evaluate these options without additional guidance regarding the manner in which business profits would be attributable to the permanent establishment of a foreign enterprise resulting from the activities of a commissionaire. The commissionaire, of course, is already subject to tax on profits. Would the business profits of such permanent establishment be limited to the difference between the profits of a local country, limited risk distributor, and the commissionaire? Would the business profits of such permanent establishment depend on the extent to which material negotiations and selling activities were performed by the dependent agent in the source country as opposed to the foreign enterprise outside the source country? The guidance to date under Article 7 is not adequate to deal with these issues. We look at this as where are the concerns that have been raised by this? The concerns are the attribution of profits and accurate pricing. We agree with both Gary Sprague and Michael Scharf that these would be better dealt with under the transfer pricing rules. If you're concerned about trying to determine what the price is and where the cost benefit is, the transfer pricing rules are already established to do that. That concludes my remarks.
Thank you very much, Kathy. And if I could now turn to Susanna Bacobo, please.
Okay. Let me check if this is working because I have a presentation, but it's not. It's okay. Good morning. I want to thank the OECD for that's here it is. I want to thank the OECD for giving Repsol the opportunity to explain our comments in this public consultation. As I only have 10 minutes, I will be concise. But before addressing the issue at hand, it's worth remembering why we are here. We are here because we want a better world. We want a better life for people around the world. And that's what Repsol is working for. Repsol is a Spanish energy company, vertically integrated and global, with a vast experience in the area that carries out activities in upstream, oil and gas exploration and production, midstream, trading and transportation, and downstream, refining and marketing our products. We are also exploring renewable energy sources. As is well known, oil is a non-renewable resource and will remain the primary source of energy worldwide for decades to come. The whole value chain of this business covers upstream, midstream, and downstream. Vertically integrated companies carry out activities in the whole value chain. And this is the diagram of the whole value chain. But let me go a little bit deeper in the activities involved in the value chain. Exploration and production of oil and gas is characterized as highly in capital investment with a low level of success on locating raw materials, and therefore with high level of risk. The reduction and diversification of this risk requires a large portfolio of opportunity analysis and a joint operation of the project to be performed together with other public or private oil and gas company. In view of its different temporal phases, exploration and production activities can be divided in 4 different periods. So it takes around 15 years from the moment you obtain the license to explore until you have a profitable production, if any. So we are patient people, obviously. Midstream, the so-called midstream activities involve trading and transportation, storage, and wholesale marketing of crude and refined petroleum products. The main goal of supply and trading undertakings in a vertically integrated oil and gas company is the purchasing and selling of products in international markets, because often oil and gas enterprises do not refine their own products and do not distribute their own products either. These mismatches are reduced by purchasing and selling crude oil and other petroleum products. Well, downstream activities, finally, include refining, which means transforming the crude oil and gas into products and marketing these products, the products you transform. These products are mainly petrochemical products that are used by fertilizer, plastic, pharmaceutical, chemical, and textile industries, among others, and other products such as lubricants, asphalts, and other specialty. Well, all that I have said before is to illustrate that most of our activities are carried out abroad with different levels of penetration in the countries we work in. On one hand, oil and gas are where they are. On the other hand, we invest a lot of time and effort in providing high-quality products. In short, extracting petroleum is not the same as trying to sell lubricants, for example, all around the world. And now, that's downstream. And now our general comments. The OECD and other organizations and the countries should fight against fraud, and BEPS supports this fight. Action 7 is for preventing the artificial avoidance of PE status through commissioner arrangements. But it seems that this action considers prima facie that in many cases, commissioner structures were put in place primarily to erode the taxable base of the states where sales took place. We believe that this assumption is not true in a majority of cases. Commissioner arrangements are legitimate ways of organizing a business. Moving on to Article 5.5, we think that it should be recognized oil and gas specialty and special characteristics. Corporate investment structures in the oil and gas sector are mainly realized through PEs in other countries. To perform exploration and production activities, oil and gas company normally signs contracts with the government in the host country. Those contracts are managed separately with different by different partners and refer to different geographical areas. Each partner has different working interests and policies, and one of them is designated as the operator. To perform activities, the operator concludes contracts in its own name, but binding the rest of the partners. So in the context of Article 5.5, the operator might be considered a dependent agent. Different obligations and duties are negotiated in each contract, even if the blocks are located in the same country. Each contract is deemed to be a PE, and it should be treated as such in both home and host country. So we see that there's a scarcity, a reference in this to this type of business alliances in the OECD model. These alliances generally are called joint ventures. Well, in relation to Article 5.6, an issue that arises in the oil and gas industry when a company are vertically integrated is the role performed by the trader companies of the group. The goal of these companies is to minimize transport costs and to supply raw materials only to the rest of the group. It's important to bear in mind that the countries which import and produce oil and gas products are located in different and distant geographical areas. The Action 7 proposal of including the wording exclusively or almost exclusively could lead these traders to have countless permanent establishments all over the world. A second issue to highlight concerns the search for new markets of oil and gas products. To begin working in a new country, it could be very important to achieve an exclusive or almost exclusive agreement with a local trader for the distribution of these products. Adding the wording exclusively or almost exclusively may prevent companies from signing contracts in new markets where exclusive agreements are required by local distributors. Taking into account the above-mentioned items, we suggest the elimination of the proposal for paragraph 5.6. I would like to finish this presentation with an African proverb. If you want to go fast, go alone. If you want to go far, go with others. Thank you for your attention.
Thank you, Susanna. And could I turn to Benjamin Schreck, please?
Excuse me, thank you. My name is Ben Schreck. I am a tax counsel with Tax Executives Institute in Washington, D.C. It's a pleasure to be here this morning. It's still morning by 3 minutes. I was thinking on the break and listening to the discussion this morning that I kind of feel like I've wandered into a real estate convention, but instead of everybody talking about location, 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 it's clarity, 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 and that it's really hard to overstate or understate the importance, whichever way it is, of clarity in the PE determination for taxpayers. If you have a PE that arises where you didn't expect one to arise, the consequences, just from a pure tax standpoint, not to mention the compliance issues that Carol spoke to earlier, are quite drastic. You might not get your deductions, statute of limitations might not have started running, so you have many, many, many open years. Not to mention, mention interest and penalties, and then on top of that, potential double taxation. So, as the slide says, taxpayers certainly favor certainty, for those reasons, and also to back up a step in the business process for purposes of making investment decisions. You need to know what the tax consequences are entering it into a country, and it's one thing to have a transfer pricing discussion where there might be a range of possible consequences. It's quite another, I think, in my mind, to have your range be zero if you don't have a PE, or several $100 million if it turns out that you do. I think it's hard to overstate, again, what taxpayers are worried about when it comes to the discussion we're having here today. To a point that I think Catherine Schultz made, it would be nice if we had a targeted rule targeted at commissionaires. I think that the language in the options A through D kind of goes overboard in terms of what it might encompass. We don't want to jeopardize the operations of dependent agents, and we don't want to also impact the operations of local sales companies in what we're doing here today. Just to move on to talk about the specifics with some of the 4 options. A through C, again, Catherine made a good point about what's problematic about this language, and it really is the second part of that first bullet there is specific persons in a way that results in the conclusion of contracts. It's just not clear what that means. I mean, the explanatory note, he tries to put a little bit more color on that of a direct causal connection between that interaction and the conclusion of the contract. But again, in thinking about this in a practical way, it's just not clear, how much activity is required, whether that needs to be, a but-for cause or a necessary and sufficient cause, or if, what happens if you have multiple but-for causes in kind of the chain of events that leads up to the conclusion of the contract. So it's just very difficult to get a handle around what might go on that might create a PE for a foreign enterprise under both options A and C. So that leaves us, assuming we have to choose between options B and D. I guess in the view of TEI, we like D a bit better, in part because it has this language here. I've labeled B, which is not present in option B, which by virtue of the legal relationship between that person and the enterprise are on the account and risk of the enterprise. At least we've got a reference to some sort of legal relationship that you can point to in determining what the intermediary in country is doing and what the foreign enterprise is doing, and also what, so you can kind of tell, or at least from the perspective of the foreign enterprise, have a handle on what's going on and a document to point to. Backing up to the first part there that I've labeled A, we've got the habitually concludes contracts or negotiates the material elements of contracts before you give rise to a PE from the actions of an intermediary. I think we like that one better for a number of reasons. In particular, it kind of reduces down the area of controversy down to what exactly is a material element of a contract. I think Will alluded to this morning that there needs to be a lot more guidance and kind of discussion about what exactly that is. Our comments go into it a little bit. We kind of say, well, maybe you should reference to material commercial elements of the contract, and what are those? Well, really, those are the contract terms that are important to the business professionals when it comes to negotiations, and not things that are important to the legal department, the HR department, or the tax department even. It's just a matter of what are you looking for when you're doing the deal. And one way to think about that is perhaps if you enter into a contract and you're going along and you're conducting your business and the contract's going well, which terms of the contract might you actually go back and reread? Well, you're not going to read the reps and warranties or the indemnities or the God forbid the choice of law provision. You'll go back and read the pricing and the other terms that are kind of critical to the ongoing compliance with the contract. So anyways, that's just a little bit of thought on how you might get there on what it exactly means to be material. But, to the extent we're not cabined in by the 4 options in terms of picking and choosing, again because they're all kind of unsatisfactory in their own way. We pointed out in our comments, well, if you're really just after commissionaires, why don't you just say that in the treaty and say, for example, any related commissionaire or similar arrangement will be characterized as a limited risk distributor or maybe a local sales company for purposes of the convention. Now, maybe that just raises issues of, well, what do you mean, what's a commissionaire, or what's a similar arrangement in particular, and then obviously then you have to determine what's a limited risk distributor. But at least you have in the treaty itself what you're getting after, rather than having the broader and probably less or more vague language in options A through D, and then perhaps putting in the commentary and obviously backed up with the discussions here today and the discussion draft of what you were really getting at was the commissionaires. Well, if you have the language in the treaty, there's something that has a little bit more weight to point to. And finally, a few words on paragraph 6. I think everybody, at least in the business community, is pretty happy with current paragraph 6. And it's not clear to me that the OECD and the member states are as hard charging on changing that paragraph as opposed to paragraph 5. But to the extent there is changes in that paragraph, and to the extent that they start to look like what's already done on paper in the discussion draft, I think what we would like to look for is a little bit more clarity around what it means to act on behalf of various persons, what it means to act exclusively, and in particular almost exclusively, on behalf of one enterprise or associated enterprises. Some of the things we point out are, well, over what time period does the exclusivity period have to arise? Is it 3 months? Is it 6 months? Is it 12 months? Was it a week? Does that all of a sudden cause someone to not qualify for the independent agent exception in paragraph 6? And the second issue, besides that, is the this would apply to anybody that's even not related to the foreign enterprise. And I think that there's some concern there that if people operating around the world through truly independent agents, they just happen to be exclusive, and all of a sudden you've got a PE because they're just dealing with you on a overall basis. So anyways, thank you very much.
Thank you, Ben, and thank you to the other two speakers and for all of you for keeping us on schedule. Let's open the floor for comments. This is in many ways the heart of what we're doing. This is obviously a very important aspect of the work. So we very much welcome contributions from the floor. Perhaps I can start with Henry Louis from the United States.
Thank you very much, Mr. Chair. I just wanted to briefly say, as we start going through all of the options in the paper, that's what we're going to do for the rest of the day. Something that I would invite in this consultation, hearing more about, it goes back to something that many of you said this morning about what is the amount of profits that would be attributable, and is the amount of profits justifiable to find a PE? That was a recurring theme from many speakers in the morning. And we as a member of the group, that is an issue that we have looked at, and we have tried to take a cost-benefit approach to the work. But I think as we go through this, I personally would welcome comments from everybody about option X having no profit or a lot of profit, et cetera. And it is something that probably the work of the subgroup would greatly benefit from.
Thank you very much, Henry. Colin Garwood, please.
Colin Garwood from IHG PLC. I'd just like to discuss this by reference to an example which I gave in our submission concerning long-term contracts for the provision of services. And the example I'm thinking of is where you've got such a long-term contract, which in our business may be 20, 30 years, for the provision of services from outside a jurisdiction to a jurisdiction where all of the people functions are outside that jurisdiction, and where under normal principles, the profits from that contract would be taxed in the residence country, perhaps subject to with withholding tax dependent on treaties, and where we're dealing with a situation where somebody is performing activities to try and find new contracts in a local jurisdiction. Now, in that context, then it seemed to me that the local activity is valuable and should be remunerated, and we organise ourselves so that it is remunerated on arm's length terms. But in the context of the contract as a whole, that's pretty insignificant. What determines value, profit or loss is the actual activities of providing those services over 20, 30 years, and not that function of finding the contract. And so I was, and what troubled me with this is that, notwithstanding proper processes to capture and tax in accordance with transfer pricing principles that local activity, that we may be sort of moving into areas or principles where that broader contract would inappropriately be brought into local taxation. Now, I wasn't clear whether, if you look at option B, for example, the caveats about unless the activities of such person are limited to those mentioned in paragraph 4, which exercise through a fixed place of business would not make this a fixed place of business a permanent establishment, may be intended to limit this. It didn't seem to me that they necessarily would, but I think the key point is, and maybe this goes to the point made by the German representative, that this puts an awful lot of, if you're moving outside normal transfer pricing principles, this puts an awful lot of pressure on how you distinguish between local activities of finding contracts which in the context of that particular business model are not significant in driving profits, long-term profits from those contracts, and how you distinguish those types of circumstances from circumstances where maybe you're dealing with shorter-term contracts and where actually finding the contracts is of much more significant value. To me, as I say, the right principles seem to be transfer pricing principles, but I do have concern that this is taking us further than we should be going. Thank you.
Thank you, Colin. Carol Doran-Klein.
Thank you, Chair. This is responding a little bit to what Henry just said. I think that one thing, but indirectly, I think one of the things that the OECD and the countries should be keeping in mind is that these rules are intended to be reciprocal, so that if a U.S. company is doing a little bit of business in the U.K. and a U.K. company is doing a little bit of business in the U.S., then the fact that neither one of those companies has a PE both benefits and burdens those countries. And the point of having a reasonable threshold is to encourage that cross-border trade in circumstances where reciprocally it kind of comes out in the wash. And I think our comments, written comments, make the point that that threshold might be different in cases where trade is more one way, so that if there's a lot of U.S. investment into a country and less investment coming the other direction, then maybe you want, in that particularly bilaterally negotiated case, a lower PE threshold. But that's very difficult to put in a model and is not necessarily appropriate for a model. And so I think, and the trade levels are changing. I mean, China now has more foreign direct investment in the U.S. than the other way around. And I think that that is an important thing to keep in mind. We're not trying to tax the first dollar of business profits in each country. We're trying to get to an appropriate threshold, and the reciprocal nature of those benefits and burdens ought to be taken into account.
Thank you, Carol. Saul Picciotto.
Thank you, Mr. Chair. Well, it won't surprise you that, again, I'd like to return to the basic point that there is, it seems to us, a fundamental difference between a situation where you're dealing with a multinational corporate group as against a small or medium enterprise. Trying to apply the same rule about contracting in the two situations doesn't seem appropriate. Where a small or medium enterprise is considering what kind of an agent, a truly independent agent, to operate and what should be the functions of that agent, that's one thing. Where a multinationally integrated enterprise already has affiliates in a jurisdiction, but then wants to consider how particular functions, often sales functions, are going to be carried out in that jurisdiction, and then quotes opts for an arrangement that doesn't create a PE for those functions. That's a very fundamentally different situation. So again, it seems to us a different rule should apply in relation to related enterprises. In that context, you could have then, we would argue, a broader rule. And I again come back to the proposed UK diverted profits tax, which does propose a broader rule that where an entity has activities in connection with the supply of goods or services. Now, but that's in a context where it's reasonable to assume no PE is intended, and that really is getting at the situation of a related entity. So you could have a much broader rule, provided it's limited to related enterprises, associated enterprises. Now, you may or may not like the definition of in connection with, but it makes much more sense because then that deals with both downstream and upstream related activities. Now, that does obviously then lead back to the question Henry Louis quite rightly addressed, is what kind of profit attribution rule do you need to deal with? But if the BEPS process is to be an integrated process, you do have to look at these in an integrated way. You can't look at the one hand at the issue of taxable presence and deal with it in one way, and then have 8, 9, 10 action points on transfer pricing dealing with the issue in a different way. There does need to be a new approach in the transfer pricing area. Once you grasp the nettle that in today's business world, it is possible to have a business presence, substantial business presence, and substantial activities which many countries want to tax the profits from, then you do have to deal with the profit attribution issue. And you can't avoid that. So it does mean looking seriously at the profit split method in transfer pricing. That would be our solution.
Thank you. Johan Muller.
I will try and answer Henry Louis' question. What we've seen in the Nordics is a very large number of cases where countries claim PEs in each other. Not necessarily commissionaires, but including commissionaires. Also the 5-4 things that we talked to later today. And the conclusion is that the problem every time is what is the taxable income. Because if you look at the assessments that you get, the assessments are normally quite big. And if you look at the functions, assets and risks, which are in the PE, quite frankly, those assessments normally are not worth the effort. I really think that I understand that we're concerned with whether there's a PE at all or not, and that people focus on that, but it is so important what is the income which is allocable, because if you stick with a functions, assets and risk approach, and you only look at the people that are in the PE, you don't allocate all kinds of functions to a PE which are not there, then we've seen time and time again that income is very low, and that has actually been a defense strategy to try and convince countries not to do it because it's not worth the effort. Thank you.
Yes, Neil Anthony.
Neil Anthony from CBI. I mean, just to put some valuation points on it, if you look at the UK government's estimates of diverted profits tax, it's only expected to raise just over 200 million a year for an economy the size of the UK. And that's, as Sol said, that's on a tax that's going wider than what's being proposed here. And I think what we've certainly seen in the paper is that actually all that's going to end up is reallocating profits between what's already being taxed in the commissionaire into what's being taxed in the PE. And effectively, you're not really going to be changing anything other than receiving a hell of a lot more tax returns in each country.
Thank you, Neil. Gary Sprague, please.
Thank you, Mr. Chair. I'd like to make some comments that hopefully will make your life easier as opposed to harder. I certainly will respond to Henry's comments about PE profit attribution during my official topic later this afternoon. But in terms of what the rule should be, we've heard from several speakers the desire for certainty. If indeed the focus is commissionaires, then I do think that there's a way to reach a lot more certainty than exists in options A through D at the moment. I could kind of sense the challenge of the drafters of A through D as they try to describe what a commissionaire arrangement means. But a much more straightforward way, if the goal is to create PEs out of commissionaires, is just to define the PE by reference to the commissionaire statute itself. As I noted, I've drafted many commissionaire agreements, and at least my preference in drafting agreements is to recite the specific statute involved. In Germany, it's section 383 of the Commercial Code. The reason you want to be precise is because you want to know exactly what rights and responsibilities the principal and the sales intermediary are assuming. And so at least in my commissionaire agreements, we recite specifically to the applicable provisions of the law. So when Ben says that he doesn't look at the choice of law, I react with horror. The choice of law is actually very important. If you want to have a commissionaire agreement, you make sure that your agreement is indeed governed by the local law of commissionaire. So I would propose that if the target is commissionaire, BEPS Action 7 refers to commissionaire. The draft itself refers to commissionaire and similar arrangements. So let me get to what the similar arrangements might be in a moment. But if the goal is commissionaire, it can be defined with precision by reference to the applicable statutory reference. And I didn't read every word of the nearly 100 submissions, but I was gratified to see that this recommendation was made by several other commentators, including Confederation of British Industry, USCIB, Chartered Institute of Taxation, Association Française des Femmes Fiscalistes, International Tax Group, and others. So it is a recommendation that many other organizations believe has merit. So that's my recommendation to make your life easier on commissionaire. If indeed the goal is to go beyond commissionaire and create PEs out of other activities, I think what is missing from the discussion draft at the moment is an articulation of exactly, what other business activities are desired to create PEs. Option B is the closest because it refers to negotiation. That's relatively precise compared to the other options. And if the desire is to go beyond commissionaire to something else, then I would agree with several of the speakers that option B is the best platform for further elaboration, although some precision around what level of negotiation activity triggers a PE would be desired. There may be a question, well, what if you don't follow the Gary Sprague model of writing down in your contract that you are governing the contract by the law of commissionaire? What do you do in those cases? Well, then you're always in the environment of, well, how do you interpret an imprecise contract? I think what the rule would be is if you've written a contract that, in fact, would be governed by Section 383 of the German Civil Code, then that is a commissionaire contract, and that is what would then be described within the new revised Article 5.5. Thank you.
Yes, please.
I'm Alison Lobb from Deloitte in London. I agree with the last comments that if commissionaires and other forms of undisclosed agent are the target here, then there could be a much simpler clause being added into Article 5 that would ensure that there was a permanent establishment of the principle, if that is what the OECD is looking for here. I also just wanted to raise a question, though, around some of the wording in some of the more challenging options, and in particular options A and C, that talk about engages with specific persons in a way that results in the conclusion of contracts. I was trying to think about how we would go about establishing what the answer was if that was the test that needed to be applied. And to start with, I would need some help with the definition of engages with. I would need help with the definition of who specific persons would be, and also in a way that results in. I think I have an idea of a conclusion of contracts, so that's fine. I then thought about the issues that this might create in relation to some of the existing guidance in relation to Article 5. And in particular, the discussion draft talks about intermediaries, but then the language that is proposed doesn't refer back to intermediaries, it talks about person. And a person acting in a contracting state is already defined in the commentary to Article 5 to include persons whether or not employees of the enterprise. And that's fine because at the moment the Article 5 is looking at the conclusion of contracts, and it's appropriate to consider whether or not those employees are concluding contracts in the local state that's potentially got a PE. But if you're then extending this out into a much wider definition, then I think we get into difficult issues, for example, in relation to business travel, where an employee of an enterprise may travel abroad to meet with a potential customer. It may be a very short trip. There is a meeting. It's that engaging with. Is it specific persons? Probably. This is a customer. Is it going to result in the conclusion of a contract? Well, maybe. It might take several months. There might be a lot more work being done back in respective jurisdictions. But there is a question there about what that would mean, or how far that interpretation would go. Now, maybe that's not the intention, but I just wanted to pick up on the fact that these kind of broad definitions would potentially bring in a lot more areas that would need to be discussed and clarified, or alternatively could lead to many more potential disputes. Thank you.
Thank you, Alison. Richard Collier.
Richard Collier from PwC. I just wanted to add, most of the discussion so far has been on 5.5, so I thought it was appropriate to make a couple of comments on Article 5.6. I take it that the objective of Article 5.6 is to test whether the agent is carrying on the business of the principal, or whether the businesses of the agent and principal have merged in some way. My own view is that fundamental point is not answered by whether the agent works for associates. And there is only one option proposed for Article 5.6. The comment I wanted to express is that I think it would be better to clarify what independence is or means, including dealing with some of the difficulties of the current commentary, for example, on financial independence, before we create more difficulties through the proposed change to Article 5.6.
Yes, please.
Hi, my name is Joe Duffy. I'm from Matheson. I think what strikes me about each proposal is that under each proposal we lose certainty, and one of the things is I still don't understand really why we're making the change. So I think the explanation offered is that it's clear that commissioners are arrangements put in place to erode the taxable base. And I think additional explanation of and definition of what the real problems are would be helpful, because in one sense it's very difficult to arrive at a solution if we don't really understand what the problems that are trying to be addressed. So if ultimately what we're trying to address is increasing tax take, then maybe the best solution, as has been suggested in a number of instances, is through transfer pricing rather than creating additional uncertainty on the definition of PE.
Thank you for a number of useful suggestions. I just have a few questions, primarily on this issue that we could easily tackle our commissioner issue by referring to the relevant provision of the German civil code or French civil or commercial code. Gary, so that would assume, so you cannot do commissioner in countries that don't have this concept. So you cannot do a commissioner arrangement in the UK and Australia? Or not?
As a technical matter, you cannot, because the commissioner is a civil law concept that is recognized in civil law jurisdictions, but not in the UK or Australia. The UK, the equivalent in the common law is an agent for undisclosed principal, right? And it's been observed many times that there is this difference between a common law undisclosed agent, which does indeed bind its principal, and a commissioner, which, as a matter of law, does not. As the treaties work today, as has been recognized by HMRC for a long time, the undisclosed agent does create a technical PE. Historically, the practice has not been to try to attribute additional profit to the PE, but only to test the commission payable to the disclosed or undisclosed agent to see whether that's sufficient. But as a technical matter of treaty interpretation, the undisclosed agent creates a PE while the commissionaire does not.
Yeah, that's helpful. I probably would have to write to someone in Australia who sent me a paper on the use of commissionaires in Australia. And I'm pretty sure I've seen concerns being raised about commissionaires in other countries, such as the UK. So that's why I said commissionaire or equivalent. This principle that you would be bound as a principal under an undisclosed agency relationship, can that be turned off contractually? Can you say that the principal will not be bound and that the both parties to the agreement between the agent and the customer recognize that the principal, the owner of the goods, the person where the credit risk and the market risk belong, would not be bound, therefore would not be legally bound by the contract that is concluded?
I know that's something that some advisors recommend. I personally don't do that because I prefer that my contracts be clear as to the relationship. And I don't understand what the relationship would be if you write down a contract that you're an agent, but you don't have authority to bind me. You know, that then sounds to me like it's not really an agent. What is it then? So I certainly have heard of people that have recommended that, but I personally have never done that.
Thank you, Gary. Sol Picciotto.
Thank you, Mr. Chair. I mean, perhaps it might help to focus the discussion if we actually identify one of the elephants in the room, the international retailing model, I think, where we do have an example in the discussion draft, but I think people know the kind of a model that there is widespread public concern about. And this maybe goes to some of the questions raised, for instance, by Carol Donoghue about do we really want these changes in terms, given that there is reciprocity. Reciprocity between countries is one thing, but a level playing field between large multinationally organized groups and small and medium enterprises, I think, is something else. We know that there's widespread public concern about the multinational retailing model and the impact that this is having on quite large, often medium-sized companies that are primarily domestic. So in that kind of a situation, the multinationally organized retailing group can situate activities which are related activities, order fulfillment activities, delivery activities, customer support activities, marketing activities in a jurisdiction, very often with actual independent separate entities, actual affiliates, so incorporated entities. But since those are treated as fragmented, they're quite separate from the entity, or they have to be treated as separate from the entity which is to which the selling profit, the sales profit, is attributed. So what people are saying is, well, what difference does it make? What difference does it make if, say, a marketing activity is seen as involving regular conclusion of contracts? Because that might mean then that the selling activity would have a permanent establishment, and that brings us up against that whole situation of what would be the attribution of profits or the apportionment of profits. Now there again, it seems to me there is a major difference between a multinationally organized group that has a very significant business presence. It might have marketing, order fulfillment, customer support, all with real taxable presences. But then simply have simply fragment its functions so that the function to which the bulk of the profits is attributed is located somewhere else, and say that well, we don't have a PE there. Now that does seem to me to be a very significant difference from the situation where you have a small or medium enterprise that has no such functions in that jurisdiction. It doesn't have customer support in the jurisdiction, at least not through an affiliate. It does hire independent agents to fulfill those functions, and that is all quite different. So I think what Carol Donohue's question came back to, well, don't we want to encourage international investment? Well, fine to encourage international investment, but the widespread public concern is that should not be at the expense of small and medium enterprises. The internationally organized retailing groups and other kinds of groups do seem, certainly to the broader public, to have a very unfair tax advantage by being able to fragment their activities in these kinds of ways, which increases the threshold. It creates a substantial threshold for a smaller company which is wondering whether to get into foreign markets through a significant business presence. So those are two very different situations. And the concern is that the tax system adds to the already considerable advantages that large groups have. One doesn't say that they don't fulfill a very important function, and they have considerable advantages. Maybe if there were a level tax playing field, those companies would still outcompete small and medium enterprises. We don't know. But the concern is that by enabling multinationally organized groups to fragment their functions in this way, they can attribute the bulk of their profits to an entity which doesn't have a business presence, even though they have other related entities that do have business presences. So then that does, if we do say, well, those are different situations, that does take us into the issue of attribution of profits. Maybe you want to deal with that as a transfer pricing issue. As I say, our own comments on the BEPS Action Points 8, 9 and 10 are rather sceptical about the functions, assets and risks approach. If you want to consider, again, multinational retailing, if you have one function which is customer support, another function which is directly owned, which is not done through an independent delivery system, but through your own affiliate, which operates warehouses and delivery. Those are under the existing approach. You have to identify the functions, assets, and risks of each, and say, well, where is the profit located? Well, it is very difficult to say. Does the large profit of a multinationally organized retail group stem from its ability to deliver within 24 hours, from its customer support in different jurisdictions? Where does it derive from? Yes, that is difficult. If you want to approach it from a functions, assets, and risks, fine, do that. But it is significantly different. They have a competitive advantage and therefore should be considered as having a taxable presence in relation to the overall group profit that is generated from the integration of those activities. That's a competitive advantage that gives them bigger profits compared to the smaller enterprise that has to operate through independent delivery, customer support, marketing. Fine. But if that smaller enterprise doesn't have the benefits of getting tax advantages through fragmentation of functions, that adds to its competitive disadvantage. So we do have to tackle, I think, the basic question, which is the difference, I think, between multinationally integrated group, where once it has a significantly related function, ought to be treated as having a taxable presence for all its activities, and then you have to tackle what is the attribution of profits to those activities. As I say, our preference is to go for a profit split. If you think you can tackle it through functions, assets, risks, fine, try it. But you do have to tackle that.
Thank you. Susanna Bacobo.
Yeah, I would like to highlight what Gary has said before, because I think it is important to realize that there are differences between common law and civil law. And for example, high courts in France, Norway, or Italy, and in Spain had said that a commissioner who acts in his own name and under the applicable general law of the state do not bind the other partner does not constitute a PE. That means that there are a contradiction between what kind of contradiction what OECD is holding and what the local, some countries are holding in relation to commissioners' structures. So I think it's important just to think carefully what the differences are and how can we deal with these differences. Thank you.
Do you want to come back on that?
Yeah, I agree there is a difference in civil law and common law, but that's why we have stressed that it's not commissionaire only, it's commissionaire and similar arrangements. The current rule in 5.5, it's not just a commissionaire in the strict legal sense as interpreted by the courts that we're concerned with. We may well agree with the interpretation of the current rules by the courts in France, Norway, and Italy, and that is certainly an interesting legal issue, but that's not the exercise of Action 7. Action 7 is to say, well, if that interpretation is correct, then we need to change the rule because there's a problem there. And the problem is not really related to the fact that you would bind or not bind the foreign principle. It's also related to the fact that the test of concluding contracts is just too easy to avoid. All you have to make sure is, as a legal matter, the contract is not concluded by the local sales force. You say, well, you cannot give final authorization. It has to be given by abroad. And it turns out that abroad almost always gives the final authorization. We've tried to deal with that in the commentary, but if you look at the wording of the commentary, it is imposing quite a high threshold for the commentary to be able to complement the provision. It has to be that they negotiate all the substantial materials, elements of the contract in a way that's binding on the foreign principle, which seems to be exactly the same as saying they conclude the contract. So this is a problem. It's just too easy to avoid the rule. And that's what we're trying to do. So I'm afraid that just saying we will fix it by making a reference to the relevant provisions of the French or the German or whatever commercial laws, it's not going to address the whole set of problems that we're looking at. We need something that will catch those cases where, and I think we've tried to articulate a policy in paragraph 10 of the discussion draft. You have a local workforce that really is doing the selling. It's just that they find a way to make sure that either the sale is not technically concluded there, and which is certainly possible, or if it is concluded there, it doesn't legally bind the foreign principle, but still the agent is not considered to be the seller for the purposes of attributing the reward from the credit and the market risk.
Thank you, Jacques. Gary, there were other flags in front of you, but if you just wanted to respond to Jacques, then please do. Yeah, please.
I guess the big question then is, what are the other similar arrangements? Is it possible to articulate as a business matter what the other similar arrangements are that are intended to be captured? Because as I read A through D, it does seem to me that there was a struggle there to try to describe in different language what the results of a commissionaire contract are. And if you just say commissionaires or PEs, then all that's been solved. And then beyond that, I think the question from business is, well, what other business models would you consider proposing as creating PEs? Is it negotiation? Is it customer support? I think if you start from that side of the equation, ask what business activity should give rise to jurisdiction in the source state to tax the non-resident, the drafting exercise could become a little easier.
Carol Donahue.
Thank you very much. I'm tempted to respond to Jacques as well, but I'm going to stick to my original my original point here, which was to respond to Professor Picciotto's comments, since he has attributed some things to me that I haven't said yet. I do think that that he has identified an elephant in the room. If the view is that the OECD should promote treaty principles that actively disadvantage larger companies, I would be very surprised and very troubled if that were, in fact, the intent of this exercise, because the OECD has not historically, I think, taken upon itself this sort of activist role in competition policy. And I personally can't imagine a treaty provision that would provide for a completely different PE threshold depending on the global size of a company and its perhaps its magnitude of activities within a particular jurisdiction. So, to me, that does not make sense. I certainly hope that's not what the delegates see this project as involving, because that would not seem consistent with the role of treaties in fostering cross-border trade and investment. That role ought to be pursued. The goal ought to be pursued for companies of all sizes. Thank you.
Yeah, just on that, Carol, a technical question, because we did get in the comments a lot of suggestions that we needed some kind of rules for SMEs, small and medium enterprises. But you seem not to be enamored with the idea that there could be something that would depend on the size of the business. Would that mean that you would rule out some kind of special rule or exception for SMEs? We don't have any in the draft, and I'm not going to say that delegates are considering that. All I can say is that this is something we found in some of the comments.
I personally wouldn't favor it. I would think that the OECD should continue to take a neutral position in terms of approach to size. I think it certainly is true that there are various de minimis concepts reflected in the OECD model and the UN model as they now stand, and if you're talking about something that is truly a de minimis exception, that might be different. But a radically different PE threshold because a company is not a purely domestic company doesn't seem to make any sense. I mean, the purpose of the treaties is to provide guidance for to avoid the double taxation and of business that operates internationally. Thanks.
Thank you, Carol. Mary Bennett.
Thank you, Mr. Chairman. I guess when I read the discussion draft, it struck me that there were at least two different and really separate issues that it was trying to address with respect to contract conclusion. And one was the commissionaire situation, where you do have this phenomenon that you have a commissionaire, no question but that a commissionaire concludes contracts with customers. You know, they're not futzing around, they're not just negotiating, they're concluding a contract. There is a contract, it is concluded in the host state in the typical case. It simply isn't binding on the foreign principal in the civil law situations. And so that was what I understood created the original tension about the distinction between civil law jurisdictions and undisclosed principles in common law jurisdictions, and aren't they so close that they should be treated the same? Maybe a debatable point, but one can understand the political conclusion that, yeah, we want to get to the same results for those. So that means at one level that you have to have, I guess, something that would say in the in the treaty that when you have a contract concluded in the host state that is not a contract between the customer and the foreign enterprise, you want to create a PE out of that. And then the question to me is, gee, there are lots of contracts concluded in host states that don't bind foreign enterprises. Which ones are going to create PEs for the foreign enterprise? And a lot of the language that is, I think, creating ambiguity in the discussion draft is where is that line being drawn by the proposals? And when you're dealing with intermediaries, and you could have, distributors that are not commissionaires, that are simply buying and selling from the foreign enterprise, they are concluding contracts. In what situations might those be swept into the language? And I think we should have some fairly open discussion about that, because from all the comments I've read, there's a lot of confusion about whether this language is intended to go beyond commissionaires and pick up all kinds of distributors, where there are two contracts, one between the foreign enterprise and one between the intermediary, and another between the intermediary and the customer. So I think that, to me, was one set of issues that needed to be addressed square on. Another set of issues, which I understood to be brought in not from that commissionaire tension, which has been discussed in WP1 for a number of years, but from the digital economy report, was what about the situation where you have activity going on in the host state which comes close to concluding a contract but doesn't conclude a contract? And are there situations where the OECD would like to say that it's close enough to concluding a contract, and a contract that is clearly going to be binding on the foreign enterprise? You're going to end up at the end of the day with a contract that's binding on the foreign enterprise. Are there situations where that contract should be deemed to be concluded, in effect, in the host state by virtue of some activity by a sales force, marketing, whatever you want to say? Again, a separate issue should, I think, be very openly discussed, and there's already language in the commentary, as Jacques mentioned, that talks about how if it's rubber stamped and all of that, that can already, under existing treaties, create a permanent establishment, but it's not robust enough for some of the players, and so let's have an open discussion about that. But I think those are two very separate problems, and I think it would be helpful to the discussion if we would talk about them separately and talk about what are people thinking about in the wording with respect to those two very separate problems. Thank you.
Thank you, Mary. Will, please.
Thanks very much, Andrew. And then actually Chaz wants to come in after me briefly. I'll try and be brief as well. This is partly actually going to answer or probably repeat the answer that Carol gave to the question that Jack asked. But I think we need to be a little careful about this small co, large co distinction and discussion, because one of the things we bring to it is almost complete imprecision as to exactly what we're talking about. Are we talking about very small companies? Are we talking about mid-sized companies? Where's the cutoff? In fact, as Georg, who's left momentarily, was pointing out to me, the Mittelstand in Germany is not exactly small. It may not be super large, but drawing distinctions on a scale can sometimes be unhelpful. And I'm going to make a point which is not countering what Sol said. I want to be very clear about that. Sol did not say what I'm just about to attribute to some other people. But this does come into the fairness discussion, and the fairness of large versus small, the fairness of domestic versus multinational, which is not what Sol was saying. But some people do say it. But it's really not nearly as clear as that. Certainly we've looked at this in the UK, the CBI has looked at this in relation to small versus large, domestic versus foreign. And actually the picture of the value chain is very much more complicated. So quite often small companies are in the value chain of large companies, the fact that large companies are successful multinationally helps those suppliers who are domestic. So it's not a question of competition, it's not a question of fairness as such, it's a question of how the value chain works. So all I would say is that I think, as Carol said, de minimis rules are appropriate. Trying to draw the line somewhere else becomes much more difficult. If we do decide we want to do that, then this, I think, if I've got my action numbers right, comes down to action item number 11, which is this is another of the places where we'd need to do quite a lot more economic research and country-specific economic research to determine this large co versus small co and foreign versus domestic. But until we have that, I think we should be quite wary about drawing distinctions in rules such as this along those lines. Thanks.
I think Will probably covered a number of things I was going to say as well, but I think we shouldn't, as Carol said, we shouldn't have separate rules for SMEs and multinationals. And I think really the elephant in the room is that multinationals probably don't pay a huge amount of corporation tax, and large multinationals, small SMEs don't pay a large amount of corporation tax, whereas multinationals do, and hence why we're having this discussion. And so how much do we want to create a cliff edge between the SME and the multinational unnecessarily, where the SME then crosses that threshold and they fall off that cliff and then go into the bigger rules? So I think we just need to be aware that really where the tax base is for most developed economies is around payroll taxes, VAT, which is on a level playing field between the multinational and the SME. So I think the elephant in the room is not to use SMEs as a Trojan horse for creating a set of complex rules, which we then find very difficult for multinationals or SMEs to both live with. So I think going forward with my other hat on, where I chair the UAPNI, the Small Business European Small Business Federation, their tax committee, I think we want to be very careful about going down the road of creating rules which are really not going to benefit SMEs and certainly going to hinder multinationals.
Thank you, Chairs. Saul Picciotto.
Yes, thank you. No, absolutely. I think we do agree on that point. I hope so, that I wasn't talking about small versus large. I was talking about multinational groups as against other firms, which tend to be obviously smaller firms that have not yet that may have significant sales in foreign markets, but have not yet taken the plunge to setting up affiliates in those markets. And they tend to be smaller. But on the other hand, you can have quite large multinationally organised groups, as the last commentator said, who then, in deciding how to organise their supply chains, decide that some functions are better devolved to independent enterprises. We have Foxconn, for example, working for Apple as an independent entity, long-term contracts and so on, but an independent entity with different tax profile, different tax liabilities, different tax residents. So sure, there are many small, medium enterprises, quite small enterprises within the supply chains of large multinationals. The level playing field we want is that where a multinationally organised group is deciding how to organise itself, tax shouldn't enter into the decision of whether it should devolve activities to independent contractors, even on long-term contracts, or whether it should operate those activities in-house. So that's the fundamental difference. I mean, maybe that's what Mary Bennett was getting at. And we're thinking of, obviously, a situation where a multinational enterprise, there are some quite well-known ones, have very extensive marketing activities in affiliates. So those marketing affiliates, apparently they're called marketing, they engage with customers to sell them services usually, but then when it comes to the conclusion of contracts, it's done elsewhere. And as Mary Bennett says, that those would be, the intention is to conclude a contract which eventually will be binding on the foreign enterprise. But the difference isn't that. The difference is that the people working for that so-called marketing entity are in an affiliated enterprise. If you want to get into a market and use an independent marketing company, that's a completely different situation. If you choose to do it in-house through an affiliate, that is a different situation. There are synergy benefits to operating in-house, which need to be recognized by the tax system. So the difference isn't small, medium, or whatever. The difference is, are you operating as a multinational enterprise, and are you therefore taking advantage of the separate entity principle to fragment your activities so that some activities appear to be in a different entity? That's the question.
Thank you. Michael Schaaf, please.
Yes, thank you. I just have a short comment on that. We are hunting for big elephants. I was thinking about what would be the result if you introduce the new definition of a PE. What would be the reaction of such a big elephant? And I was thinking about that. What is done regularly presently is that year-end adjustment. So what is about a distributor having agreed with his parent company a year-end adjustment? In that case, the distributing entity won't really bear a market risk. And without that market risk, I'm quite close to a commissioner. So the question would be, could I adjust my profitability of a distributor because of an agreement saying you will get a minimum profitability to that profit of a commissioner? So that would be a reaction I could imagine. So that would mean we would create a new definition of PE, but we haven't hunted that big elephant. So I'm wondering whether it makes really sense to discuss that issue more on a transfer pricing aspect, on the aspect of allocation of functions and risk, and maybe artificial segregation of functions and risk, instead of founding PE by a commissioner, because there are some models which then allow to prevent that use and application of the new definition also.
I'm going to give the last word before lunch to Jacques Sasseville.
Well, I suspect it's not going to be the last word on the issue. It's just going to be the last word on the exception. I think there is a number of large elephants in the room. What you just described is interesting, because we did talk a lot about if we tackle the commissionaire, should we go after a low-risk distributor? And we said it's not the PE issue. As long as you are in a situation where you start your analysis by doing the accounting sales minus cost of goods sold, which you would do with someone who has the contract legally binding that entity to deliver the goods and to perform all the obligations of a vendor, a lot of administration think they're in a lot better position than starting and saying, well, I have to adjust the commission based on arm's length principle, which means they will give me a bunch of comparable commission rates that independent commissionaire are being taxed on. And that is a crucial issue. The PE issue is exactly the one where you conclude a contract, but it's not you who have the market risk, the credit risk, because the ownership of the goods that are sold belong to the entity that's abroad. If you tell us that we should also tackle the low-risk distributor, well, that is certainly a valid point, but I can tell you some of my colleagues are looking at that, and this is part of the work that we're doing on transfer pricing.
Thank you very much, Jacques. Well, I think we will stop there for lunch. We're